Good afternoon, everyone. Welcome to Shadow Trader FX Hour. I am Blake Young, and here, as I said a few minutes ago, in Chicago, broadcasting live from Chicago. And hope everybody's doing well, and hope you had a great weekend. Remember, you can follow us at MyTrade. Go to mytrade.com, and you can follow us there. Follow all the Shadow Traders, and you get our daily updates, calendars, news events, etc. Also, this is recorded and will be posted to Shadow Trader's website at shadowtrader.net under Archives under FX Hour. Without further ado, we're going to jump right into the charts. I'm going to switch this over to a bigger image, better image. We'll call it hopefully better. And see if we can't make this easier for everybody to see. And like I said, this hopefully will help us out on the connection and the things that we see in the chart. So you should be able to see the dollar index right here. And yep, we'll go to gold and a currency price. No, not gone to the mothership. I'm doing a different conference. I'm doing a broadcast, an event for InvestTools on Forex. All right, so you should be able to see the charts. Now this is the dollar index, and this has been an interesting one because I've been waiting to buy the dollar. As you know, if you follow the daily count or the daily newsletter, I've been waiting to buy the dollar. I've been looking for this opportunity. Been watching for the euro US dollar to reach these peaks. And what was really interesting is we saw a test of the peaks on the dollar index, but not on the euro US dollar. So we didn't get it from the euro. The euro was artificially strong, and so we were waiting, and you can see the different support and resistance levels that we're watching for. And so you can see right through here. Well, let me change that to a price level instead. And so the price level that I was watching for is this close. And as we zoom in on that, like I said, we're trying a different aspect ratio and broadcast. But as we look right through here, you can see that we fell down. We tested that support level 4 days ago. And as we hit that support level, we bounced off it and created this amazing hammer, or maybe almost a dragonfly doji. Well, the next day we traded down a little bit. The next day we didn't trade within that range, and so it's showing a little bit of uncertainty, and we expected one more push down on the dollar index, but this appears to be truly a higher low and could be setting us up for the return to the uptrend. The dollar could be coming back to a multi-month bullish trend on the dollar. Now, as we watch this, let's go ahead and look at the euro US dollar, because this is where we missed our opportunity, because the euro US dollar didn't do the same thing. And we've been waiting for this. We watched for it. We set limit sell orders up here, and we saw that we had these closes and these shadows up through here, and we expect it to come up and retest this level where we had all these closes, these shadows, this shadow, and we got up to 114.35, and we put our order in to sell it up near that level, and you can see we just rolled over and we sold off really aggressively. Now, that doesn't mean that we're not also in these lower highs. That doesn't mean that we're also not set up for a bearish opportunity in the euro US dollar and still could get into it. This is a big enough drop that we are looking at it as a lower high. And so we are going to watch for a little bit of a bounce. We're going to look for this. I'm going to cut right through here because I'm going to make a prediction. I know, how many times do I miss the dang thing? But I know for a fact that you were looking for 118 with me as well. That I was looking for first 114.50, and that I wanted to sell it right there, and it didn't quite reach. And then by the time it reversed, I was on an airplane. So that didn't work out too well for me. But there's still an opportunity in here. So let's go ahead and anchor our reverse anchor. And I'm going to cut right through here because that was a gap up, close down. I like this better. See how we're hitting both those closes there? And hitting this level. Let's redraw it. Yeah, all the things of what might have been. So let's go ahead and anchor it like this. Now that is my trend line. Now if this is the beginning of a lower high and lower low, this does give me the opportunity to hit that reverse fib fan technique. And as we look through here, we're going to anchor it like so. Once. And we already see that we're breaking through, and so let's go ahead and anchor it twice with the idea, the concept that we've still got to get down for the long term through this lower low. If it goes through this lower low, that's going to confirm the long-term dollar trend up. It's going to confirm this down, and I'm going to look for all these support and resistance levels to match up together with some Fibonacci levels. Going back even further, you can see we had these highs up here, and as we drop this down, we could go right here. That doesn't give us much to work with. But if we drop it down into this area or even down to this close and look for where these are going to intersect. So tomorrow I'm not going to be surprised to see a test and a bounce off of this level right about 108.43. Now, I would like to see us sell again. I'd like to see it reverse back up and give us an opportunity to sell near 112.50 over the next 2 or 3 days. But we're going to watch to see, is it going to give us a pullback and a test of 112.50, or is it going to give us a bounce up at 108? Either way, we should be able to sell near 111.50 or 112.50 over the next 2 or 3 days. If it continues to go down, and if we break through this low, this is the main one, 108.50-ish, somewhere near here, near the 7th of July, or really anytime before, that gives us a target down to 104.86. That's the most aggressive target that I'm going to put on the table. 104.86 as a potential, or 104.90. Call it 105 and be generous to ourselves that we're going to get out quick. But 105 sometime as early as, I can't see the dates there. There we go. As early as the 8th. And that gives us that downside pressure. Now, why else would we like this? Why else would we look for this? So let's go going back to the dollar index. We're set up for the same scenario, same higher highs and higher lows. So if we did the same technique, anchor up to the highs, I really think we can go all the way back up to these high closes. And we redraw it from here to here. And then we're going to use a fib reverse anchor technique that I've taught you before, like so. And we'll give ourselves a duplicate in case it shoots through the highs. It doesn't give us the same target. I don't expect us to get up to 102. I expect us to potentially get there by 7.6 or 7.8, right about 99.77 as far as the dollar index is concerned. Now, the dollar index pushing up to that level, going to your other questions, would mean gold should be going down. What have we seen? Gold tried to rally. They tried to push it up with some fear. You can see it peaked out right here, right at the 1200, like we talked about, and rolled back over. So there's key support areas right near 1171, and the next support area down here right around 1145. 2 weeks ago we talked about that. 2 weeks ago we said we should see some bearishness in gold. We said that 1200 still is a resistance, and we should see it fall back and find that support level. And that is some major pippage. Absolutely. And as we're looking at this, you know, as far as gold is concerned, this is gold in relationship to the dollar, right? Now, we can do other ratios, and we can try to do other ratios of gold to other futures, and we can do a ratio chart. Put in a ratio here. A pair ratio. And we can try, nope, that's not what I want. I want, mine. Price ratio. And we can put in gold futures. And then you can put other symbols in, like the euro. And it should give us a little bit of sense of where that should be. Now that's 105.20. Now this is the chart that is kind of adjusting if you want to do it this way, and this is one way you can do it. This is looking at gold quoted in euros. And what it really is, it's 11.77. Remember that the euro US dollar, actually I did that ratio wrong, didn't I? I think I may have done that ratio wrong. No, this is right. So this is what, because the euro is worth more than the dollar as far as per currency, even though it's fallen back down, it should take less euros to buy gold. And so this bottom chart is basically euros, or gold quoted in euros. And you can do the same thing with yen. You could do the same thing with Canadian dollars, pound, anything you want to quote a future on. That will give you this price ratio chart, which is gold quoted in euros. And as you can see, it looks a little bit different, especially through here. This is what I find very fascinating. When gold prices were falling really quickly, the euro was falling really quickly, and so you see that it was really kind of going sideways from July, August, September, October. So it looks very different than what we saw gold prices compared to the US dollar. US dollar, big drop when we compare the gold in US dollars compared to flat all the way through there. We saw the rally. That meant the gold was going up faster than the euro was, And then, but as you can see, we can do the same things, the same types of price patterns as we're looking at these moves sideways as well. This move, lower highs and higher lows, and then lower highs and lower lows, this is a downtrend for gold, and it's actually a cleaner downtrend for gold when it's compared to the euros. So let's switch that price ratio, and let's go ahead and look at it in something else. Now this is one that I get questions on. Is there a way to quote gold in terms of yen? Yes, there is. It's a price ratio. So here's a price ratio of gold quoted in yen. You can see it takes. Now this is 100 yen. So come back here to the 6J just so you can see what this looks like. So here's the 6J, 0.0080785, right? So what we're looking at here is you need to really move that over a couple decimal places, and that is 150,000 yen. It's in thousandths. 150,000 yen to the dollar, or to the gold, to an ounce of gold. And that's what it costs right now. You can see the difference in that one. Gold is not weakened when it comes down to the Bank of Japan and the yen, because the Bank of Japan has weakened the yen so much that that inflation really appears in gold prices. I don't know if you've ever looked at it this way, but this really gives you a sense of which currencies are hedging, which currencies are experiencing inflation as compared to gold. And you can see the yen is definitely one that has had a huge amount of inflation. It went from approximately 130,000 to 155,000 yen to an ounce of gold. And it's pulled back, but it's already back in an uptrend, so there's still some weakness, even though the Bank of Japan has indicated they're not going to make a major change. Hold that thought on this. We can come back to this price ratio in a minute. Let's go ahead and hit the S&P. Let's talk about crude light, and we can come back to these inflation questions and comments in just a minute. So starting out with the S&P. One of the questions I've got over the last couple of days is what is equities going to do next? Because we called the bounce, right? Then we called the rollover. Now this bounced right at the support area. Zooming in on that. Right at the support area. Turn the corner, is right back up here. The big question is this going to be enough to push it through to the upside? Are we going to see price move and push this to the next high? As we look at the moves that we've had previously, there are some pretty significant trends going on when we look at the longer term channels. As I take this channel, and I can first off split it just right down the middle and look for some support and resistance areas there. I can also put that 75 and 55. Now this is one area that if you're interested in a trending Fibonacci channel, you can change your channel to a 38.2 and a 0.618 and go ahead and show those. Now this is a trending Fibonacci channel. And you can look for those resistance and support levels to be created through there. Now, is that the right channel? We certainly hit some key support and resistance levels there. We're about at the 50% mark, which minimally I'd be paying attention to that as we're approaching the high side. Even if we break through, there's still a little bit of resistance up here, both from the Fibonacci channel and the 61%, or the 61% and the recent highs near 2133. Are we going to see enough demand or enough interest in owning U.S. equities if we're expecting some resolution on Greece? If Greece is going to have some sort of resolution, are we going to see more interest, more demand in the European current equities, more so than in the U.S.? If the euro is going to weaken, if they're going to continue to bail out, if they're going to continue to offer money, if they destroy their currency, or I shouldn't say destroy it, minimize it by putting out more money and saving Greece, which it appears that's the direction we're going, there's going to be an opportunity there. Well, when our currency, when the US dollar was weakening a lot, when that happened, we saw US equities rally even faster. The question is, are we going to see US equities rally faster than what we're going to see demand for in European currencies, in the DAX, in the FTSE? And I don't know if that's going to be the case, and so I'm still expecting us to stall out here. Now, as we look at the S&P, it certainly is having a hard time getting any higher than this mid-channel. Let's look at the NASDAQ, because that was one that has seemed to have done the best. Just trying to look like this. Make sure I just clear out some of that. It looks like I need to pause each time that we switch pages. The NASDAQ is the one that everybody seems to be focused on the most, and you can see that we've stalled at resistance again. Hasn't been able to break through. With all the excitement, everything going on, tiny little day. And look at our volume. Our volume is drying up as we get to that resistance area. From the long term, we can also look for some channels, and we can do the same kind of view. We can even come all the way back here and cut through that top right there, which is what I kind of like right on that price pattern. Getting that channel through there, hitting as many closes or bodies that we can. We'll edit the properties, and let's go ahead and change this to a channeling Fibonacci again. 38, 61.8. And you're going to see that we have this key support and resistance areas here in the middle. And I would venture that's probably about 75 and 25 down on the downside. But you can see that is stalling out here, horizontal resistance. We have had these support channels almost perfectly at the 61% drawback. So even if we roll over, I would still look for it to bounce near 44.46. I just don't expect a lot of bearishness or bullishness for the next month or so on equities. As we look at the Russell is a small cap, the one that people are a little bit more concerned about, and they're the ones that we're betting on. And that's kind of the same thing that we're seeing in the Eurozone. This is the one that's breaking out. The NASDAQ has everybody talking about, hey, look at the NASDAQ, away it goes. But it's really the Russell where people are taking the risk. It's the small caps. It's the one they're going to gamble on. And you can see we've already broken through the recent highs. We've had some bullish movements. And even though it's slow, making smaller bodies and lower volume, it's still making new highs. And so as we're looking up here, theoretically the Russell could hit 1310, and as or if it does, that's the area we'd want to see if it stalls out or if it breaks through. That's the big question. I just don't see it breaking through. And so you might watch as soon as the Russell hits its high, if it rolls over and has one of these big sell-offs like it did here, or as it did here, that could be a more significant sell-off, and we'd watch for it to get all the way back down to the 1242. Let's go in and look at the Dow, just as our last one. We've already looked at the others. So, oops. Look at the Dow minis, and then we're going to come back and hit oil. Certainly we can look at the FXE. Dow, we're looking for the best return. We're not looking for safety. That's the way I'm reading this. Investors are looking for not the best return, or sorry, not safety, but the best return they can get. And so the Dow is fairly flat. Let's go to crude. Crude light. You want me to cover purchasing power parity. Okay, let's see what we can do there. We do need to do that again. It's been a while. So crude light continues to trade between 62 and 57. If you look at these shadows, really that's 62. This one overshot it just a smidge. But I like this right through here, where we just keep testing 61.79 horizontally almost perfectly. As we come down to these lows, right about 57 or 56.90. Multiple weeks. I looked back historically, and I was looking at this on the long term, and I have not been able to find any time frame that was this flat for this long, going back on the weeklies, as far back as I could go, looking for it to stay that flat for that long on the weekly. And the first time I had to go all the way back to where it was trading in this range, which was actually a wider percentage. But this range, back when we were trading here and in the 30s and the 20s, because it's still trading in a $2 or $3 range, but it was a wider percentage. So looking out to where we're at here, this is some of the flattest action we've had. Now, it did break out and it moved that distance, about twice that distance, and came back. But I couldn't find anything that would really help us see something that has been this flat, percentage-wise, in this long of a time frame, in this range. What is this now? 10 weeks. 10 weeks and about 7%, 8%. So 10 weeks and 8%. So crude is really stuck in this range. And I think part of it is that, and I've said this last week, if I recall. We talked about it last week a little bit. But we looked at is we said this is a situation where we've traded so flat for so long, but it's not because we have higher demand or this is where supply and demand are really balanced out. I think what happened, you know that we built up all the inventories and supplies right through here. And we built them up into the millions and millions of barrels when it was dropping down to the 47, 48, 50 area. Repeatedly, that's when investors stepped in and really built up inventories. As they built up those inventories, this is probably where they're liquidating that and keeping prices high. Anytime it starts to dip, then then they stop selling off and they hold on to it and people buy it back up. So it feels like that's the case. Now as we look through here, the time frame that it was in or at or below 50 covered a couple of time periods, but it really went about 90 days through there. So could we look at the same idea and look for about a 90-day move sideways in oil and push us out to the end of July? I don't think that's too big of a stretch to think that's, if we're having similar volumes down here, that similar volumes up here could eliminate or liquidate a bunch of the supply that is being put onto the market up there. And then you're not going to see the same demand because then people have all bought it up here. Let's take a look here. FXE, told you we'd look at FXE. Let's see what that says. This is going to be a lot like the Euro US dollar. And looking at this should be almost identical to the Euro US dollar here. Looking at the price pattern, the only difference between the FXE and the Euro US dollar is that this is an ETF based on the Euro US dollar, so it's only an 8-hour a day trading time period, and so that's what we're looking at through there. So 8-hour time frame that's causing that to do that, have the little gaps, but overall it's the same thing. So if you're like the FXE, if you're long the FXE and you're looking for the bullishness on the FXE, well, then you should be also long or bullish the Euro, and you're looking for it to get back up to some previous resistance. Now this is a big day, a big down day. You can see we've done this before. This is a bigger day than these days were. And so as we're looking at this sell-off, that could continue lower. Like I said, I'm looking for a quick bounce, so I think this is probably an overextension just like you're looking at. And we can look at the volume on it. Going into the 6E, you can look at the volume on it. This average volume on a big down day. It's not really high volume, it's pretty average. And that gives you a good sense of whether investors are really stepping in or not. So one of the questions I got is on purchasing power parity. For those of you that are not familiar with it, I'll spend a session of the FX Hour on this. Purchasing power parity, one of my favorite things to look at, is just comparing how much purchasing power a currency has. And so one of the things we can do is we can actually go in and compare CPI changes or percentage changes from one country to the next. And so when we see a country or a currency, let's say the currency, let's say the pound, if we're using the pound, well, when we see the British CPI comes out and they say that, oh, our CPI shows a 1% shift or 1% change in pricing. What that's saying is that their currency should have decreased by 1% against a basket of goods and services. Well, if we saw the same 1% in the euro or the eurozone, theoretically those two currencies should be moving in lockstep. They really shouldn't see any real change, net change, because both of their purchasing power, when compared, are at parity. They are similar, they're identical, they're weakening or strengthening the same amount. And so if they're weakening and strengthening the same amount, then that would be an indication that we are seeing either inflation or deflation, depending on which one we're looking at, of the same amount, and the currencies compared to one another, the comparison should be that there's no change. Right? Now, if we had one currency that has a significant change, say 3% inflation, and another country or currency has 0% inflation with the purchasing power, then that would indicate that that currency compared to the other currency should have shifted the same 3%. And we'll do the math on it, and we'll do this another session because we can spend easily a half hour, 45 minutes doing it. But what that would also indicate is we probably see similar moves in gold, similar moves in oil, and that currency pair. So if we were to look through here during this time period on the euro US dollar from up here to down here, theoretically that ratio, if we took the euro back here at 136 ish and looked out this many months, what is that, 252 days, call it 3 months, or 9 months, excuse me. So over a 9-month period of time, over 3 CPI reports, we should see a difference of about 22% in inflationary data, theoretically, between those two currencies. Now that's compounded over that 9 months, but that should be roughly what we saw. And that would, again, hit these price ratios in gold as well. And we could do the same thing. What we're doing is we're comparing everything in gold, right? Let's go ahead and do that. Let's do that with, let's change this one to the pound. And like I said, we'll do this another time in more detail. But so here is gold prices quoted in pounds down here. So if we were to look a year ago, and let's compare it to gold prices in the US. Which, you know, honestly, I saw inflation at your farmers markets too, for crying out loud. It was crazy. Food is expensive where you live. Very, very expensive. It made me appreciate things back on the mainland. Made me appreciate the fact that I could feed my entire family for less than $100 per meal. So, as we're looking at this, gold prices a year ago were $1,300. That's US. Gold prices on the pound were $7.74. Okay? So, what we could do is we could determine the purchasing power of the dollar compared to gold and the purchasing power of the pound compared to gold. And theoretically, we should get the ratio and the change from there to there. So, and I'm not going to get this exact because we're just going to look quickly. If we have 1318, I'm sorry. Let's do this again. If we have the pound, which was 785, so 1318 US divided by 785. At the time, theoretically, we could be all the way up to 167. But right now is what I want to see. I want to see if we can get this ratio to be the same. Gold prices in US are 1177. And gold prices in pounds are 749. Roughly. So theoretically, we should be at 157 for the pound US dollar. What do you know? 157.27. Ta-da! I didn't get it exact, but you can see that's really all it is. That's how currencies' values comparatively are made. They should match the cost of gold, or the cost of gold in each currency should match, if you take that ratio, should match the currency's values in the currency pairs. If it doesn't, there's an opportunity for arbitrage. If you had a few $1 billion, then you could do it. So a comment, Newsbot says Bank of Japan loan supports program which is given to financial institutions close approaching Japanese yen 30 trillion according to the Nikkei. Now remember, 30 trillion yen, one more time back to the dollar yen, just commenting on this news report. Back here, it takes 123 yen to buy a US dollar. So comparatively, your 30 trillion, 30, 1, 2, 3, 4, 5, 6. I don't know if it'll even let me do it. Here's 1,000, 10,000, 100,000, million, 10 million, 100 million, billion, 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 trillion. I think that's what it is. Divided by 123. So what is that? 1, 240 billion. So not nearly as big as our 15 trillion that we have in, or 16 trillion we have in our own debt, right? Corey asked a question. So your price ratio with the Aussie should show a precise inverse relationship with the yen. No, well, you got to remember that your Aussie yen, your Australian dollar has weakened as well because it doesn't have the same correlation to gold. So comparing that right now it isn't working because gold has not been able to strengthen the Aussie when it rallied, and it hasn't hurt the Aussie very much. There's a lot more going on in the Australian economy than we're seeing right here. So when we look at that and we look at the gold prices in Australian dollars, let's do that first. Let's just change this to the 6A. When we first compare it to the Australian dollar, you can see that gold has actually been able to maintain. The Australian dollar has hasn't been able to gain or lose, kind of stuck. And, that's been good through here, but it was through here from November through February that the Australian dollar lost value related to gold prices. So gold prices compared to the Australian dollars went from 13 to 16 and saw a 25 to 30% increase in gold prices, or look at it as a decrease in Australian purchasing power there. So it's not quite the same just because we have some other effects that are happening with the Australian economy that has weakened the Australian dollar. So notice there is the ratio of the gold to yen. See that? Take a mental note. And then as we look at that back again to the Australian dollar, you're going to see they're pretty similar this year. And that's because, again, the Australian economy has struggled as well. Why has the Australian economy struggled? Why has the New Zealand dollar struggled? A lot of it has to do with the fact that the global market has slowed down and that Australia and New Zealand really, really, really need to be able to sell their goods and services. They are commodity producing countries. As we've talked about before, New Zealand, something of close to 15% of its exports are dairy. And Australia, they're similar, but it's in metals. And so when Australia and New Zealand aren't selling as much, specifically to the Asian countries, when the Asian countries like Japan and China and Singapore have economic slowdowns, and they talk about the Chinese bubble and the fact that there's not enough growth there, and the fact that the growth that has been there has been artificial, then people are concerned and they say, oh wait, they're not selling anything. There's piles of copper sitting on the ground in China, and so therefore they're not producing and they're not selling and people aren't buying it. And that is what weakened the Australian dollar with the yen. Now this is my greed and fear trade. It still has some validity because VIX still helps, or rising fear helps the yen. Falling gold prices has hurt, but the Aussie some, and the rising has helped it some, but not nearly as much as usual. But you can see here we are stuck in this range. I'm still using this, and I can still say I expect commodities to stay where they're at roughly, and we can see some bounces a little bit. But in addition to that, I also expect equities to stay relatively flat. If I want to see the equities break out, I want to see the Aussie yen break through the highs. Yep, the greed and fear play. And Royal, one of the comments that I'd say towards the Japan is circling the Keynesian drain is just last week they're saying, see, it worked, and everybody is all sorts of excited. Everybody's commenting that, hey, things worked out. Our easing policy is finally paying off. Well, 20 some years later, we're calling a couple of months positive. So I would lean to your beliefs that they probably are circling the Keynesian drain. However, the markets were sure happy with the fact that we saw growth in Japan over the last month. All right, API is due out. Crude light. Let's go back to crude light again. Question is, can this be a shooting star, and what would that mean as you look and we're rallying up? Oh, there we go. Are we moving here? Let's take a look at the short term. Yeah, pretty uneventful. Spiked up, spiked down, even a little bit bearish as we sit. as I live and breathe. We're still between that support and resistance area, and what I would be looking for is I'd be looking for it to roll over and potentially come back down to these support areas and bounce again. Just watch for it go back and forth. And as such, then what I'd be looking for is some relative flat behavior in the dollar CAD. Now we got into this relative flat move back here on the dollar CAD, and we traded in a range from January all the way, a couple of breakouts, but really January till April, so 3.5, 4 months that we saw price trading relatively flat. Now, we've established there's a different resistance here and a different support. We could really kind of shift everything down a little bit. But if we know this support area and this resistance area could play out, I can cut those off because you see how it spiked up and then reversed and then gave us tweezers? If we cut that off, that's going to match a lot closer to these previous support and resistance areas. In fact, if I redo this, actually let's redraw the whole thing. Let's zoom in and draw it a little bit cleaner. Boy, I don't know. Now that I'm zooming in, I don't know if it can get much cleaner, because this reversal area here interests me, where we had the reversal candles here, kind of a itty bitty tweezers. Then we had this big bearish engulfing. If we cut it off there, or this bearish engulfing, cut it off there. What if we were to do something like this? Try to get that to 0, as close as I can to 0. There we go. And back down to this support area. Let's extend this to the left, and let's duplicate it just for fun. Ah, what do you know? That's beautiful. Oops. There we go. So it could be resistance through there, could be support through there. I'm not going to be surprised to see crude light stay sideways, and therefore the dollar CAD stays sideways for the next little bit as well. How did I do the channel fibs? All I did is drew a channel. This is the drawing tool at the bottom left. It's the double lines. And if you click on channel, draw yourself a channel anywhere you want. Right click on it, edit properties, and what I did is I changed the 25, 50, and 75 to 0.382, 50, and 0.618, and made them visible. And that makes a Fibonacci channel. Yeah, and that's kind of what I'm going with, Royal. A lot of manipulation, and I go back to the crude light. The comment is that what's happening is we built up all these inventories at the low prices, and now every time these speculators that bought it at the low price, they're trying to manipulate it and keep it in this range so they can liquidate their inventory. If they bought at 45 or 44 or 48 and they can sell at 60, not bad to be able to make 33% in a matter of 2 months, 3 months. Yeah, and they can manipulate it and slowly get rid of their inventories. So the fact that they're liquidating their inventories at these higher levels, is that actually a bad thing? If it's all the speculators that bought at the lows, then what are we really looking at? How is that lower inventories, if anything, sets up for after they clear out their inventories, that it could push back down lower? If they're trying to force it and keep it higher. Yep, let's hit copper. Copper. Alright, copper. Little bounce today. Trend still looks down to me. My confidence in a copper rally is contingent upon us breaking out of the channel, and even better, breaking through this previous resistance area and support area right through here. See, I'm cutting that one off again, and I'll be willing to cut that one off again too. So look for it to break through this area about 270 before I'd be willing to get bullish on copper. Right now we've had these bullish moves, rolled over and dropped again. In fact, this could be, if you're a Fibonacci or a Elliott wave theorist, could this not be 1, 2, 3? This could be the fourth wave, especially since it's not going to enter into the first, which means I still think we have a push lower, and that means we could retest 246. Now, that would put us to an annual low, to an area that we have seen the markets recover and rally before, and so that would be an area that I'd be interested in buying into copper and looking for, hopefully, some growth and some demand increasing as well. Yep, it's summertime, people. Flat markets, flat equities. Doesn't mean the currencies won't move. Currencies still do interesting things. Aussie US dollar. That's what I mean by the Australian economy is weak, struggling. It was interesting a few years back. Took my family to Disneyland. And when we were at Disneyland, convinced them just to hang out at the pool and hot tub and everything for a little while. Can you guess what year all the Australians were there at the hotel and Disneyland as well? 2011. 2011, 2012, the Australian dollar is trading at 110. That was a significant boon to their economy and their purchasing power. Again, going back to the purchasing power parity that we talked about earlier. Same thing, 2011, right through there. You can see the New Zealand dollar similarly was way up these highs. The drop from 88 down to 68, or the move from 68 up to 88, that's a 28% increase in a matter of just over a year. As someone that is living in New Zealand, Australia, and others back at that time frame, can you imagine if you're looking at traveling and you know you want to take a vacation, you're looking and saying, oh, I can go to the U.S. and it costs me 25% less, or my dollars go 25% further than they did a year ago when I was planning my trip. And I did actually talk to some. They're from New Zealand, and I asked them flat out, so, did you come here because of the exchange rate? And they said, we actually already had determined we were going to come over, but everything we're able to make our trip a much bigger trip than what we had planned. It confirmed everything that I thought, and that's exactly why they did what they did. They were already planning on coming over, but it made a major difference for them as far as their purchasing power in the United States. So we already talked about the CAD, we already talked about the Australian. Let's go to the dollar yen. Dollar yen has made higher highs, higher lows. It broke out through here. The pullback was looking to come back potentially to test this low through here. Now, if we cut off that move right through there, this is interesting to me because it could, if we cut off that tweezer, anchoring those closes, this could be the breakout. Now, we have 1 minute. It's not going to fall back down to these lows, so this could be the breakout, and this could be a bull flag. If that's the case, this bull flag goes from about 118 to 124, 124.70, so about let's call it 119 to 124. So we've got about 550, 575 pips to go on this breakout. If I use my Fibonacci extension, if we see continued weakness in the yen, I'm going off of closes now. If we see continued weakness in the yen, this breakout here, either the close above or a move at least 10%, would put me on track for a potential move all the way to 129.38. Now that may seem like a long ways away and something that is not attainable or that it's never been there, but that's not true. It has been there. As we look back over some time, you can see we've been there multiple times. We've been there in 2002, and we've been in there at the end of the Asian contagion, the Asian flu, in 98, 99. So this area right through here, this area right through here, and 129 is actually a pretty reasonable target that doesn't even have to hit the highs of 2001, 2002. And that's a lot of weakness for the yen. They had a banking crisis through here, and it pushed it up to 147. I don't think we're that far away from the idea of a banking crisis or at least a currency crisis again. And so a move of this distance or this magnitude is fairly minimal for the dollar yen to be able to move that far. Let's go to the pound US dollar. Pound US dollar. This one's an interesting one to me. And so if I had to make a prediction of where this is going to go and how fast it's going to get there, one of the things, just make sure my recorder is still going. One of the things that I would look for, and you won't be able to see this on the live, but you'll be able to see it in the recording, is a return or a repeat of that move back up to this high. Let me change it so you can see it on this side. Let's use, we'll just draw it with trend lines. The fact that it's rallied from here to here and then pulled back like so, then rallied from here to here. This is kind of an ugly looking Gartley pattern. It's not the prettiest. Now theoretically, if it fell back down to this area, it could be a bullish pattern right through there, and we could see a long-term trend. But what I'm looking for more than that is I'm actually looking for it to rally up again here. And let's look for it to get up about the same distance it did off of these lows. So this move from here to here was approximately 5 days and 2.17 or 333 pips. So 5 days and 2.3, right about this resistance area right here. This is oddly specific. I'm going to look for a move somewhere between the 7th and the 8th of July that maybe we fall back, bounce, and then put in a lower high here, and that could be the big reversal. So again, I'm looking for some bullishness in the pound, either bouncing off these old resistance temporarily or falling down to this level 153 and then getting back up to 156, 157. And that would be an area that I'd be willing to look at shorting the pound US dollar for a longer period of time. And I would also be watching crude light as it did that. Let's see. I've covered crude light, but how does that correlate with UGA, unleaded gasoline, which has been rising? You know, so UGA, this is a different fund. You know, you look at this. Remember, the difference here. In fact, let's use. I just forgot the symbol. Help me out here. Retail gas futures. It's not RG. What is it? Ah, shoot. Come on, Blake. Think. RB. Retail gas futures. There we go. RBOB. You'll notice it looks a lot like UGA, right? So let's use this as a little bit more liquid, as far as easier to see as well. When we're looking at this, yeah, it did rally up, and yes, it bounced it through here. But remember, this is a double situation. We're going to look at the demand and supply on oil, certainly. But a lot of this still has to do with that every year, every single time, there is an increased use of retail gas. Not necessarily an increased use of crude. Crude oil and other things that go on with there. Remember, there's other uses of petrol or petroleum-based products and diesel and other things like that. But the retail gas, this is hit more so, and the demand is increased more so by the summer travel, one, and two, because we keep changing, or we shut down refineries for maintenance every year. Every year in March, April, and May, when they know that the demand is going to be high. They make their money during those months. They're sitting on barrels and barrels and barrels of oil. They are not demanding more oil, but restricting how much they're producing. They're altering, it's a supply chain situation. So the retail gas and the UGA, the retail gas future in the UGA, is being driven more higher, more on the basis of the fact that we have less supply, that we have facilities shutting down for maintenance. I'm putting that in air quotes because it's always the same time. And then you have one that goes up in smoke, and then you can't build another one because there's a moratorium on any type of new station, even though they could build them more efficiently and better locations, because they won't let you put them on the coast. And so you cannot build any more refineries. So they keep taking these refineries down every time during the most busy time. So it's more of a supply of retail gas and not on oil supplies. Bango, How do I like the pound dollar? I'm just looking for a bounce. And you got to remember, I'm also bouncing, betting on the pound being stronger relative to the euro. I still think the pound's going to hold some strength through there. So retail gas, whether you're doing the RB or the RBN5, same thing. That's just this front month. Yeah, Greece will continue to kick the can down the road. Eventually, I think with the euro-US dollar hits parity. What causes these moves at the end of the day in the forex? I think it's a shift because it's remember that the banks. This is an intra-bank market. Is the banks trading? Remember that little lawsuit and the settlement they had from manipulation of the currencies? It's because the banks are the ones that drive these moves. So they're trading and dislodging their exposure. Rather than taking all the risk on themselves, they're getting rid of that risk. And so on the futures market, they're divesting from risk and they're doing things. So when the futures market's closed, generally speaking, that leaves them with one choice. And so as they're looking at their holdings and they see what they're able to clear out and what they picked up, they still have to go in and they have to change that. So as we're looking at that and looking to change their holdings or change their position, they still have access to the 24-hour market. That is the currency market. Yeah, so GFC, remember with futures on commodities. Yeah, so what are we seeing there? You seeing a difference in the months? Let's go to the trade tab. Can you see this? You still see this, right? We didn't do much in the ags. We'll go back and do this. Okay, so you guys can see this? All right. So in futures, on a commodity specifically, first off, there's generally a little bit more, how do you say this? Risk premium? I don't know if you'd really call it that. The idea behind futures, remember, is that we're looking at investors committing to buy or sell things at a later market. And so contango occurs theoretically when the forward price of a future contract is above the expected future spot price. Backwardization, or normal backwardization, is opposite of contango, when the forward price is lower than expected future price. So when we're seeing these things, there's generally a little bit of premium being tied into this. And we basically look for things to have a higher premium for the future. And you see, this is interesting. So maybe this is what you're looking at. 08, 04, oh, there we go. Decreasing. So remember that normal we expect to see higher prices in the future. This is a little bit backwards. And so let's do the same thing on crude. Crude is going up each month. So there's a little bit of disconnect there. Let's hit the ZQ really quickly. I know this is not a commodity, but let's hit the ZQ. And I told you we'd hit ags, and we are running out of time really fast. So um, last week, when the Fed said we would be waiting for information that would support a rate raise, blah blah blah. Again, the market said that seems like you're delaying, kicking the can down the road a little bit further. You can see October's are now 99.77. Before it was 99.75, where we had it basically a lock that we'd have the rate hike by October. This any number above 99.75 starts to put that into question. And now it looks like we're possibly pushing out to November for that time frame. Let's go through some of the ags really quickly, starting out with the DBA. And I'm sorry, but we are running low on time really quickly. Here's the DBA, Deutsche Bank's Agricultural Fund. And you can see we've bounced off the lows, but we certainly haven't ended this downtrend. Overall, the downtrend is down, and it's still there. We haven't made any set of higher highs and higher lows. And yet we look at individual things like corn, and this one is pushing through the near-term high. Now, that doesn't mean higher highs and higher lows, but it certainly gets us closer to the idea that we could be setting up for reversal. It gives us a nice little double bottom setup that could reverse that, and we could see corn prices rise. If we look at wheat, keeping to the ags, you see a very similar situation. Now, this one does set us up for potentially higher lows, but we've got to get to the higher highs. So we have these higher lows here. We got to get to the higher highs before we have that change of trend. We go over and look at cattle futures, and the cattle futures are not there. I haven't looked at cattle futures for a couple of days. Not quite there. Coffee and cocoa. Coffee, way weak. Remember, coffee still is about 10% of that DBA, as well as cattle is about 12%. So the fact that cattle and coffee are not bouncing. And as we look at cocoa futures, cocoa has been doing really well. And we've seen higher highs and higher lows all the way up through there. So we are seeing some stabilization, but not bullishness yet. And I don't expect it overnight. And because of that, I also expect continued weakness in the New Zealand dollar. Their farmers are all but going bankrupt. I brought this up a couple days ago. Remember that mining operations like Australia and oil operations, they can shut down. They can stop production, and it costs them a little bit in interest and other things like that. But in the big picture, they can pause, and their cost to pause is only opportunity cost and whatever they have to pay for interest or loan expenses, interest expense. However, agriculture, that is not the same thing. You can't say, I'm going to stop production, and then right at harvest time you say, oh, prices are high, make my field full of corn. They can't snap their fingers and make it happen. They can't just start up the combine and have corn and wheat to harvest. Same thing with dairy. Same thing with live cattle. Same thing with hogs. Those animals still need to be fed. They still have to be worked. They still have to have all the staff and all the hands to help out too. And so it becomes very problematic for those countries that are really dependent upon that, because they can't just flip a switch nearly as easy as they can non-living commodities or plantable commodities. So the ags really suffer during these time frames. All right, we did hit gold already, but let me circle back around. Gold anticipation is we bounced off 1200. We expect a little bit lower move called 1171, but then it's not going to surprise me to see us fall back down to here. If we're looking at, hooray, the Eurozone is going to solve their problems, watch for gold to come all the way down to 1145 before pausing it, and then watch for that quantitative easing action from the central banks, specifically Japan and the Eurozone, to see if they pick that up again, because that could turn gold back up. But right now we're looking at some weakness through here. And short term, another 1%, but let's look to see if we get all the way down to about 3% lower down here. Just reading some of the chats here. And so one comment I'd make about intraday, remember, the faster you're moving, the shorter the time frame. It can be a sharper knife, but it might be sharper just because it's thinner. If you're trying to make more money in a shorter time frame, you're trading short, 5-minute charts, 1-minute charts, 15-minute charts. Trading intraday, it's not just a sharp knife. Sometimes it's just a thinner knife. And so you get a thin knife to try to shave off some dollars and cents. The problem is that can make that knife break, to complete an analogy there. But as you're looking at that, remember the shorter time frames are harder to identify trends. They respond quicker. You sometimes don't have the time or the ability to respond in a timely fashion on that time frame. So I'm not a huge fan of this intraday scalping. I would rather look at the things that happen and hit over days, weeks, and months, because those fundamentals can hold out for that time frame. The fact is the supply and demand is going to play out in the long term. Speculative moves happen in the short term, and the question is, can you keep up with the speculators? And unbelievably, we're out of time. So I'd just be cautious about the intraday. I'd look at the longer time frames. You know, and I don't follow sugar very well and soybeans, so I really don't have much to say with that. It's just not something I do spend a lot of time on, so unfortunately I don't have maybe you're thinking fortunately I don't have anything to comment on that, but I just don't have a lot. I don't follow the soybean or sugar very much. But watch for a short-term move. We got a significant support level here. I think you do have another one lower. The problem is we have this gap based on the front month. This is this September's, which is the U5. You want to see it without the gap. You can certainly put in the U5 here and see it without the gap, but it doesn't give you a sense of that where you might find future support levels. So what I would do is I'd flip this over and look at the TYX, which is the 30-year Treasury Index, and look for the highs that it can hit and look at the time frames that it can hit there. And so the fact is that if we clear this high on the TYX, the yields here, rising yields, then we are likely to push up to this yield from a technical perspective, which means that we're looking at the support levels that go back to July and August, and that means we would be looking at bond prices to continue to fall to July and August levels, which theoretically would be all the way back down here. So I would pay attention to these ones first, about 144, and then potentially 135. All right. We hit HG. I talked about HG. So I think we hit it all. All right. I tried to answer all your questions. If I missed something, feel free to send me an email, fxtrader@shattertrader.net. I got some other requests. Like I said, I am remote this week, so I will try to get back and do some other things in the next few days and weeks to come. Let me know if you have any questions, comments, or thoughts. fxtrader@shattertrader.net. Join me next week at 4:15 Eastern. And from all of us at Shatter Trader, all of our very best and very best of success in all of your trading, everybody. Take care. Talk to you next week.